Hello, everybody. How's everybody doing? Welcome to the session today. It's June 21st, 2022. And my name is Jose Blasco. Welcome to the Tiger Live session. We call our sessions SMART. Apart from being smart, I guess it's fair to say. SMART stands for Special Market Analysis Report for Tiger Traders, which means that we're going to be looking at the markets, analyzing the markets, but most importantly, and that's why it's SMART, we're going to be looking at special market data, which is data coming from the options world. Often options markets, which are derivative instruments traded typically by the very large traders. So often those markets, that market data coming from the derivative arena, if you wish, reveals powerful information when it comes to what's likely going to happen in the marketplace. So we're going to be relying on such information to have a better analysis, which is going to be smart. Before we get started, as you guys are coming in, I would like to highlight a couple of things. First of all, the fact that our disclaimer is in the upper left side of the screen. Please read it carefully. This is important information indeed. It is fairly short, so counting on you to read it completely. Please do so. Second thing, it's about the use of the chat box. So again, we're going to spend, let's call it 30 to 45 minutes, probably more 45 minutes together, looking at a series of things, including an options lesson that we're going to discuss. So feel free to use the chat box anytime for comments, for questions, for opinions, for requests, for future sessions. The point is, do not be shy. Okay, everybody ready to participate. I'm here for you guys. Let's make this time to count. The markets will open in a couple of hours from now. So let's, prepare ourselves the most we can. And for sure, let's do not leave any stone unturned. Any question you may have as we go over the materials, please feel free to interact. Or as I said, maybe suggestions for future sessions and so on. Okay, so happy to hear. The best way to test that you guys are ready and also to know that I'm watching you, it's to just type a quick hello message, both on the YouTube channel chat box as well as in the Tiger Brokers app. If you could type on the chat box hello, not only it's a nice thing to do, it's kind of you. On top of that, now I know you hear me well. We are all ready to interact and grow during this session today. So let's begin. Agenda. We're gonna have a brief introduction. I'll talk a little bit about myself. It's super brief. Obviously, this is for you, not for me. Key headlines. We'll talk about what's happening out there in the world, which is a lot. Options lesson. So we're gonna talk about non-directional trading, as you will see in a moment. We'll get into our special market commentary, which is the title of the Tiger Live session, and then I have a bonus for you. And for sure, questions and answers, we can leave them to the end, but to be honest, I prefer to grab them on the fly so I can give you more relevant answers. Okay, so please go ahead and again, interact with me. The more, the better. Oh, by the way, I almost forgot to mention, you can see there is a very powerful QR code there on the screen. This is a coupon code. This is a card, I should say, a card coupon. Where you get 0 commissions for trading US options, which is the key asset that we're going to be utilizing in today's session. So if you haven't yet, take a screenshot, grab it. Probably the team at Tiger Brokers will also be pasting some links on YouTube, etc. So you have it accessible, but it's on the screen, so grab it while it's there, okay? Very nice. Wonderful. Next one, Jose Blasco. Who is that guy? Well, that's me. I am a trader. I trade all markets because really, to be honest, like all vehicles, they are all cool. They all have advantages. They also all have disadvantages. It's like if you compare a bike with a car, an all-terrain with a supercar, they are all vehicles, but they have different characteristics. And therefore, depending on what you are trying to accomplish in the market, could be long-term investing, could be short-term active trading. Depending on what you're trying to accomplish, different assets may have more advantages than others. Okay, so that's why I particularly specialize in all assets because of that. I'm a true lover of the markets, and that's what I do. Okay, so now having said that, talking about true love, I have a little bit of a special something for options. Options give you options. Options are choices. More choices is something that I do welcome, and therefore here I am today, ready to add more to your knowledge when it comes to options trading, or reinforce the knowledge that you already have, and happy to work with you. Our company, which is the company I founded, you can find it using our website, tradewithufos.com, as you can see on the screen. What are the UFOs? What is UFOs? You may be wondering. Well, it stands for on-field orders. So again, if you know where are the buy on-field orders in the market, if you know where are the sell on-field orders in the market, then you know when to buy, you know when to sell. So then basically what I'm saying is that you know when to get in, and you also know when to get out. So you can time your trades better. And this is applicable to all assets, even options. Even when we do non-directional trading with options, you will see later, knowing where the limits are, and the limits are going to be the red UFOs above and the green UFOs below, would allow you to have powerful trade setups. Okay, so this is the bread and butter of what I do in my trading. We have a website around that, so we welcome you to go take a look, and probably you'll find value there. If not, or if you have questions when you look at the website, shoot an email. At the end of the presentation, I'll share my email with you guys, and you can connect with me directly if needed. Okay, happy to help, as I said. So headlines. Russia-Ukraine geopolitical tensions. This is something that is absolutely not new, but it's still there. And it's still one of those things that, while it seems that everybody, and it's sad to say really, but it seems that everybody knows is there, and it's looking like it's going to be there for a long time, and therefore people started to pay less attention. Again, just being objective with my observation, not that I feel like that myself, but that's what it is. So with that out there, it's important to kind of not to forget too much about it, right? And not to get used to the fact that this is happening, because anytime, any moment, something may happen which may generate another push for the markets in whatever direction, depending on what's happening. So this is something to watch. I'm sure that we're going to have spikes of volatility here and there when certain decisions are taking place, such as, for example, the EU accepting Ukraine as a EU member, for example. So if that was to be confirmed, so probably all those things would have an impact in the market, and it's something for you guys to watch and always keep in mind. Good. So what else? Well, the interest rates. Okay, the interest rates with the US dollar are key. The US dollar is very strong at this moment in time because they have been rising interest rates to try to fight the inflation. Again, nothing new, but this is really what's moving the markets. Everything else is just, with all respect for other news, it's kind of noise. There are certainly news that are more important than others, but it's kind of noise, especially when you think about the power of what the US dollar does when the US dollar is being intervened, like those changes of interest rates. In a moment, when I'm done with the slides, which will take me not too long, I'll move to real-time charts. And the first chart I plan to show you is actually the chart of the US dollar. And you will see how understanding that chart is actually even more important than knowing about the news, because that chart is going to tell you basically what's going to happen to the dollar, and therefore what's potentially going to happen to all the other financial markets which are priced in US dollars, like when you trade stocks. Okay, you buy Apple stock, you pay dollars, right? And if the valuation of the dollar changes, obviously the valuation of Apple stock is going to change too. Today we have 29 earnings reports coming out. They are not too relevant. The one that is most relevant is LEN, Linear Corporation, and that one is, I would say, worth it to watch. But the other ones, I mean, there could always be surprises and so on, but normally they're going to be less impactful in the sense that they are small companies and things of that sort. So anyway, with that said, we understand a bit more about what's happening out there. We're going to go through our options lesson so we get more prepared to then get into the market analysis, the SMARTT market analysis for Tiger traders, so we can go ahead and understand better the ecosystem in which we trade on June 21st, 2022. The options lesson for today is titled as Non-directional Trading, Bread and Butter, or an extra spice for your account. So what does that mean? Well, there are multiple things here that we need to discuss. First of all, what is non-directional trading? Which to some of you, it may be understood already. To some of you, you may be like, non-directional trading? How do you make money like that? You need to get direction, right? You need to be right, and the stock goes up or goes down if you're short. Well, guess what? With options, remember, options give you options. There are ways on how to profit which are not necessarily directional. So that is something that we're going to explore a bit deeper today. But also the second concept attached to non-directional trading is should this be the only thing you do? Should this be your bread and butter? And the only thing you do in your account is non-directional trading. Okay, what are the advantages and disadvantages of approaching trading this way? Or should you add non-directional trading as an extra spice to what you already do, right? So maybe you have a portfolio made of stocks, or maybe you're building portfolios and protecting with options, or doing cover calls with options. Whatever you're doing in the current time, should you add non-directional trading to your current portfolio? So it's kind of like adding an extra spice to the mix, so it's gonna be tastier, right? So should you do that? Again, of course, everything starts with understanding non-directional trading, and answers will start building up naturally, depending on your personality as a trader, your trading plans, your size of your account, how active you want to be. All of those things will basically give you answers as we go through the lesson. Again, this is the initial concept I would like you guys to think about. By the way, everybody has been extremely quiet in the chat boxes, both in YouTube as well as the Tiger Broker app. So at this moment in time, I would like to request a serious message, okay, a serious, okay, Jose, ready for the lesson? Everybody types ready for the lesson, because now we are beginning, and I need to make sure you are ready for the lesson, because now I need your attention fully, okay? Maybe you were a bit distracted because it was the introduction, but now we are going full speed, okay, guys? So please, a quick message. Thank you so much, Genman. This is very appreciated. Very nice. Thank you so much. Thank you, guys. Good. So let's go for it. So first of all, what is non-directional trading? Well, non-directional trading refers to the use of option strategies where profits can be made no matter the direction in which the stock has moved. So that's what non-directional means. It means that you don't necessarily need a specific direction of movement for the profit to be made. Now, the first thing that comes to the mind, especially, I guess, if you have a mindset similar to me, to my mindset, you know, meaning that before trading, I was coming from engineering, I am a perfectionist. So with that kind of mindset, you read non-directional trading, and next thing you know, you're like, oh, well, what does that mean? Is this a sure thing profit? Is that no matter what, you're gonna make a profit because it doesn't matter which direction is it? No, of course not. Why? Because you still need to pay for the trade, right? So to enter the trade, you're gonna have to commit a certain amount of capital, and therefore, you know, you could certainly profit from the lack of movement, but depending on the type of strategy you use, there is a moment in time where basically you are not making money because, you know, too much or too little is happening. So again, non-directional means that it doesn't need to go up, it doesn't need to go down, but there are other requirements that also need to be taken into consideration, which set you being a profitable trader or you losing money on this particular application in that particular stock. Okay, so we need to discuss that. Okay, wonderful. Thank you so much for those ready confirmations, guys. So the two main types of non-directional trading opportunities or strategies are the debit non-directional strategies. And if you recall prior lessons, that means that you're going to be a payer of options. You're going to be a net payer. You will buy and sell options all together, all combined, but the net effect will be you pay X amount in premiums, okay? You can also be a credit non-directional trader, and therefore it means that you're going to be buying and selling options all together, all mixed, and then the net result of this combination of options contract is going to be a credit, meaning that you are net receiving premium, which will, you know, decay every day as we are approaching the expiration date, similar to what we discussed in the prior week. Okay, so let's go deeper. What is to be a non-directional trader for a debit? Okay, well, with debit non-directional strategy, profits can be made no matter the direction in which a stock has moved, as long, and this is the key, as long as the magnitude of such move is significant enough. In other words, you get into the trade, it doesn't matter if the stock goes up or down, you're going to profit, but it needs to move by a minimum amount for you to profit, you know, to be net profitable. For example, let's say you buy a call and you buy a put at the same time. This is called a long straddle or strangle, depending on the strikes. So if you buy a call and you buy a put at the same time, if it goes up, the call will make money, the put will lose money. If it goes down, the put will make money, the call will lose money. But what happens after a certain size of a move, the call has lost all the value, or the put has lost all the value, and therefore the other unit has infinite potential to make as much money as, you know, as the stock moves. The more the stock moves, the more the other unit moves. while the losing unit has limited risk. Why? Because when you pay for a call, the most you can lose is what you pay for the call. When you pay for the put, the most you can lose is what you pay for the put. So let's say the put is losing the whole amount, but now the stock is moving by a lot. The call is making unlimited. So you lose the put, but you make unlimited with the call. So you are a net profitable trader. Now, this implies that the size of the move has to be significant enough for the call profit to be greater than the loss of the put in this particular example, right? So that's why you are non-directional. It doesn't matter if the move goes up or goes down, you're gonna profit no matter what, but you do need the size of the move to be significant enough. If the size of the move is small, then basically the two options you bought, the call and the put you bought, will basically expire and you lost everything you paid, which is the debit paid. So the debit paid to enter such trade is acting as a hurdle, as the stock movement has to surpass this threshold for profits to be made. Okay, classical applications, there are many more to be honest. The classical applications of non-directional debit strategies are long strangles, long straddles, where calls and puts are bought at the same time. Okay. Later, I'll take a look at the charts and I'll give you some application with the real-time charts, and you will see that. Let me lay out the concepts first. So the non-directional trades for a credit are kind of like the opposite, but the opposite, let's not, oversimplify. There are a few subtle aspects of it which we need to discuss. So with credit non-directional strategies, profits can be made no matter the direction in which the stock has moved, same as before, as long as the magnitude of the move is contained. It's the complete opposite. In the debit non-directional strategies, you need the stock to move at least by a certain amount. In the credit non-directional strategies, it doesn't matter if the stock moves up or down, but you don't want the stock to go too far up or too far down. The size of the move has to be contained for the trade to end up as profitable. Why is that? Well, because the credit received to enter such trade is acting as a buffer that allows the stock to fluctuate up or down by that amount. So think about it. Let's say you sell a strangle, okay, or a straddle. It means that you sell a call and you sell a put, or different strikes, same strikes, or we'll talk later about iron condors, okay, which is a more advanced application, if you wish, even though it may sound intimidating to new traders when we talk about iron condors. Please do not be intimidated. You will see how this is way simpler than what you think. But anyway, so let's talk about strangles or straddles, which is when you sell a call and you sell a put together at the same time. Well, when you sell a call and you sell a put together at the same time, you get paid premium twice. You collect premium from the call and premium from the put. Let's say the total amount of premium collected is $10. Okay, so what happens now? Well, if the stock goes up or down, now one option is making money and the other option is losing money, right? Now, let's say the stock moves enough, so one of the options becomes in the money. So if you are short an option which is in the money, on the expiration date, you're gonna get a sign, which puts you in an unlimited risk position. You can lose the whole thing, right? I mean, if you got a sign on a put, the most you can lose is the put strike to zero, because the stocks cannot go below zero, so you cannot lose unlimited. But let's say it feels unlimited, so let's call it unlimited to simplify the mathematics. Okay, so if you sell an option and you get a sign, the most you can lose is unlimited. Okay, let's phrase it this way, just so we are conservative. So what happens? Well, for me to be exposed to lose unlimited, I got paid premium twice. Let's say it was $10. So what's the most I can lose? Okay, it's unlimited, but for me to start losing, the stock has to move at least $10 against me. Because if the stock moves less than $10, then I'm gonna make money. Why? Because I got paid 10 to absorb the price fluctuation of the stock, either up or down, by $10. Why $10? Because that is the premium I got paid in this made-up example. In a moment, I'm going to show you real-time examples, and you will see how this looks like. But this is the concept. Instead of paying premium, you get paid premium, and therefore this premium is acting as a buffer that allows the stock to fluctuate either up or down by a certain amount, which defines an upper limit for the range, a bottom limit for the range, and as long as the stock remains within the range, then the trade will be profitable. If the stock moves beyond that range, so then you start losing money, and the more it keeps going, the more you lose. You can lose up to unlimited unless you have contingency plans. For example, an iron condor, which is limited risk instead of unlimited. Okay, so again, we'll talk about that later in a moment in the slides and also in the real-time charts. So let's talk about an equivalency, just to understand non-directional trading a bit better, because let's face it, it's a bit abstract at first. If you never heard of non-directional trading at first, it feels a little bit abstract. So another way to think of being non-directional is to think about being neutral twice. So if instead of non-directional, I use the term neutral, now I am referring you to the prior lesson that we covered, where we talked about being bullish or bullish neutral, or being bearish or bearish neutral. And we started using the term neutral. So let's say you are going to be neutral twice, right? And in the prior lesson, we talked about credit spreads. That's when we introduced the concept of being neutral. So what if you do two credit spreads together at the same time, right? You do a bear call spread above price, and you do a bull put spread below price. Again, I'm using terminology from the prior lesson, even though it's on the slides. Okay, so in a prior lesson, we went over credit spreads, which could be treated as neutral, as a neutral approach to trading amongst conservative traders. Selling a bear call spread and selling a bull put spread at the same time, that's 4 units. That would be neutral twice. You are neutral with a bear call spread, and you are neutral with a bull put spread. And even if you think about it, the bear word neutralizes itself with the word bull. The put word neutralizes itself with the word call. So the bear call spread kind of neutralizes the bull put spread and vice versa. So you are neutral twice, okay? So two credit spreads, the way I just described, become what we call an iron condor. Okay, there are different ways on how to think and define an iron condor. This is a very simple approach, but certainly it's very pragmatic and makes a lot of sense. So an iron condor is basically you are doing two credit spreads at different strikes, one side with the calls, one side with the puts, and therefore you are neutral. You are neutral twice because credit spreads, as the name suggests, generate a credit. So you generate a credit twice, and now as long as the stock stays above or below a certain level without trending in a specific direction, so then you're going to make a profit as the stock remains in that range. Okay, so this is an iron condor, and this is the kind of like the classical approach to non-directional trading, which I would like to illustrate real time on the charts, which I'm going to show you now. As always, before I show you the charts real time, I'm going to take a sip of water. And in the meantime, I also want to point at the information that you have in the screen at the moment. You have a QR code for you to click on it, to grab it, and to go sign up for the free 3 months access to our coaching plan. So we are running, like today, for example, today at 11 p.m., we are doing live options trading on our website. So if you want to participate of our live trading options, I will do Thursday. Today is going to be my colleague, Josip. So if you want to join us and learn options trading with us, you can just do it for free on our website. And for that, you have to go through the subscription process, which is going to be free, thanks to Tiger Brokers and thanks to this QR code. So grab it. I will grab a sip of water and we go live with the real-time charts. Here we go. Thank you so much. I am going to share my other computer screen. So please bear with me 1 second. It's not going to take time at all. Just want to make sure all is good. Yes, I believe all should be good. So what I want to do, the first thing I want to do is I'm moving here to TradingView. This is the dollar index futures. I told you that I would show you that, and before I forget, before I get into the iron condors and all of that, so I wanted to show you the dollar index, and I want you to notice how we talked about this last week, by the way, that the dollar has been extremely strong, extremely strong. You can see, you know, when we met last week, it was on the 13th. Yes, correct. This is when we met last week. 13. Yeah, I think so. I think it was the 13th. I would say so. Yes. So it was looking very, very strong. There was a red UFO above price, and as the dollar came into the red UFO, it reacted down, created a new red UFO. Price came into the red UFO and started falling again. So because the dollar is becoming a bit weaker, okay, in the past few days, obviously the equity markets are moving up. In a moment when we do our market analysis, you will see how the S&P today is going to be opening up with a gap up, which is pretty significant. And why is that? Well, it's because the dollar has been falling. That's why it is. And by the way, it's likely going to fall a bit more until it gets to this green UFO, where now it's going to be likely going to go back up. And guess what's going to happen? Well, as the dollar goes down, the US equity markets are likely going to rally. Now, careful with that. We'll cover the analysis in a moment more in depth. It's probably going to be a bear rally, meaning that we're going to get to price points on the S&P, where from there, we're going to fall very aggressively one more time as we get to this green UFO and the dollar goes back up, okay? So again, I wanted to show you the importance of the US dollar graphically, visually, since I mentioned that earlier, okay? In any case, let me now move to our real-time platform top so I can do some analysis. Let me remove the probability cone. We don't need this for now. So here I have a chart with Apple. Let me float it so we'll make it like full screen, okay? And what I'm going to do with Apple is I'm going to add a study, which is going to be an options replay, okay? And actually, I'm going to, just to make it more fun, I'm going to use an earnings options replay, okay? So the earnings options replay, the exercise I want to do, talking about non-directional trading, is I would like to look and see what happens if I did, for example, short straddles every time, or short strangles every time Apple report earnings. So 5 days before earnings, I enter a short strangle, okay? And let's see if we did that the last 2 years, which is 8 earnings reports. It's 4 per year, every quarter. So 8 earnings reports, that would be 2 years of data. So let's go ahead and simulate what would happen if I did short strangles, which is a non-directional trading application since 2 years ago, every time Apple reported earnings, okay? So we are coming here, okay? So this was the date of the earnings. That was in October 29, 2020. And guess what? You know, on that particular date, okay, if you had done a strangle, so you would have ended up here with a profit of around $1,000, okay? So what if you did a strangle on the next case? While the trade showed at some point negative P&L of minus 486, so the trade ended here with more or less $1,000 of profit. What if you did it on the next earnings report? It showed, you know, minus $100 of loss to then close with a profit of $228 of profit. This one never showed any loss. It closed at $709 of profit. This one basically broke even. Okay, it showed up to minus $400 of loss, but then kind of broke even. This one here showed multiple iterations of loss up to minus 188, but then ended up closing on the expiration date at $791 of profit. And the last one, actually, the last one looked very problematic because almost every single trade was looking very powerful, but of course, coinciding with the craziness that we've seen in the markets, and more specifically on the technology industry, the last trade, which was non-directional, would have lost, you know, $1,700, $1,631 to be precise. So you can see how these methodologies could produce, of course, it depends on the markets and the stock and the dates and the strikes and how you put the trades together. But you could see how non-directional strategy could be your bread and butter. That's the only thing you do. Do non-directional strategies around earnings, for example, or every week. Or maybe you do that as a spice. So you are trading your stocks, and when earnings are about to happen on key stocks that you may follow, then you throw some non-directional strategies such as a short strangle, okay? Now, the one I pick here for simplicity is a short strangle because you sell a call and you sell a put, but I do need to warn everybody, if you are not used to what's a strangle, please don't do it, because a short strangle is one of the riskiest strategies because you sell a put and you sell a call together at the same time. And therefore, I mean, you can see the size of the loss here surpass, you know, multiple sizes of the winners. So again, overall, if you keep doing it, in this particular case with Apple, it seems that the backtesting results would show profit, but, you know, that would be, you know, probably a very big hit in your account unless you're managing a risk in other ways. Okay, so, you know, just keep that in mind. If you don't know what's a short strangle, please don't do this. and you can even explore other alternatives, such as, what if instead of a short strangle, I did a short iron condor, short iron condor right here, right? So what if I did short iron condors? Well, you will see how the size of the profits and the losses are different. Okay, so the information is being loaded. 1 second. Here we go, it's happening. It's loading. So you can see how, some trades are breaking even, some trades are doing very little. This trade made 300 something, and this trade made 158. Okay, so again, of course, you are reducing the risk. You are also reducing the reward of the trades. With an iron condor. Okay, but the beauty of an iron condor is that the risk is limited. Okay, so I guess this is visual enough for you to see the impact of doing non-directional trading through time. Of course, I will need so much more time to go over a complete, a complete lecture on how to put this together. That's why I gave you access to the 3 months coaching plan, so you can go and come and see us how we do it, because we need much more time to explain it. I'll just flash one idea. So I'm scanning here for high implied volatility. I'm scanning here for stocks which are in neutral zone, daily and weekly. And for example, here I can see EA. So for example, I could take EA, which has UFOs above and below. So it's likely going to stay in a range, because if it goes up, it's going to fall. If it goes down, it's going to rally. So you could set a range from here to here, where you would expect EA to stay in that range for a while. And then what you could do is you could launch a spread select builder with short iron condor, just following out what I was mentioning a moment ago. And let's say maximum risk is going to be 500, and I'm going to build 99 iron condors. And then what I'm doing here, I'm doing it, by the way, at the speed of the light. Okay, so if you don't follow me, it's okay. I just want you to see the concept. So I'm just loading my iron condor preferred parameters. This is a filtering condition. So when I add my filtering condition, so this will allow me to sort. And now notice that out of all these combinations, 4 pass with 29%, 29, 26, 27%. So it seems that 29.23% is the best iron condor. And now, I can go ahead and graph it. And my iron condor will be made of using July 15, using the 115, 120, 140, 145 options. Okay, here are the strikes. And this iron condor will produce $114 of premium per contract. Okay, in this particular case. So that's an iron condor. That's how you can build it. Again, we'll have more lessons in the future. Join us in the live coaching sessions so we can explain that properly. Right now, I just wanted to flash it so you get a visual of how this could be done, because as you can see, it's powerful stuff. It could be your bread and butter. It could be just extra spice, depending on how you want to approach trading, okay? Anyway, so let's do our market analysis now, okay? So now we are changing topic, okay? So we are now moving from the lesson to our SMARTT analysis, okay? So we're gonna be looking at market climate, cycles, calls and puts, implied volatility, volume map, UFOs, all of those things. So let's begin with the S&P futures. So the first thing that you can notice here is that the S&P futures is gonna open 1.45% up. On the left, I got the S&P ETF, which is still showing the close as of last Friday. Today's open is going to happen at 371, which is more or less here. So we're going to have a gap up, okay, from Friday close. We're going to open and start trading around this price point, which, if you do the math, it's 1.45% up, at least in the futures markets. Okay, so you can see what has been happening in the futures markets. Okay, and that's why the SPY ETF, and therefore the index, the S&P 500 index itself that represents the US market, is gonna open up. Okay, now what's happening so far? Well, in the past few minutes, this is a 34-minute time frame chart. So in the past 1 hour or so, the S&P has been falling a bit, but now it just came into a green UFO. So we are expecting that this will go back higher. So again, we are expecting an open to the upside on the market. Now, again, careful. We talked about the dollar index already before. Careful as well, because this is actually something that was expected. The climate is currently pointing at 6. So we've had 6 red dots confirming the climate to be down, where probabilities suggest 3 is a normal thing to happen. So we surpassed ×2 the duration of the down climate based on what statistics suggest would happen. We've surpassed everything based on statistics, to be honest. We also reached a maximum distance of extension of 2.58, where 2 standard deviations of normality would be 1.09. So we went 2 times further than normality. So no matter how you look at it, this is statistically non-sustainable. So I'm not surprised that it's going back up. But having said that, careful, because we may change to blue for 1 day or 2, and from there we are back going down. Okay, plenty of red UFOs above price, both on the futures markets, as well as if I switch to S&P ETF, you can also see, especially here at 387, a beautiful red UFO waiting for price to come. So the market closed on Friday on this green UFO, not a surprise that price is higher. But when price comes to this red UFO, it would probably turn it around and go back lower. So again, careful of being hopeful, especially if you have a portfolio loaded with long trades and it's been painful to see the market going down. Probably you're looking at this rally like, oh, that's it, it's coming back. Maybe yes, maybe not. Based on market data, what I'm reading here is that it's a bear market rally. Okay, why am I saying that? Well, see this gray line above the blue line. What does that mean? The gray line is the implied volatility of the puts. The blue line is the implied volatility of the calls. So what does it mean when the implied volatility of the puts is greater than the calls? It means that more people are either buying puts or more people are selling calls. They are making the calls cheaper by selling them. They are making the puts expensive by buying them. And why would you buy puts? Well, because you're bearish. Why would you sell calls? Well, because you're bearish. Okay, if you were bullish, you would buy calls. If you were bullish, you would sell puts. So buying puts and selling calls both are bearish actions. And right now you can see the differential between the gray line, the puts, and the blue line, the calls, and therefore there are many sellers in the marketplace. So in other words, as the market rallies, those sellers will show up or will be expected to show up, slapping the market down again and have this short-term rally in the context of a bear market end and have another impulse to the downside to push the equity index markets potentially lower by X amount of percent. When looking at the daily market on the S&P, okay, if we look down, okay, there are multiple UFOs below, right? So if the market goes down, there are multiple UFOs to bring it back higher, okay? But really, all those UFOs that are here are not going to be too powerful in the context of a down climate. So if the market keeps falling, many of those on-field orders may be canceled and simply generate short-term rallies to get to the next red UFO, fall down, rally to potentially a new red UFO that form, and then from there fall down and so on. So for the ones of you that may not have understood what I meant with a bear market rally, that's what I mean. So those rallies to the upside may only be this, okay? So far, as long as the gray line is above the blue, we have realistic with the market data that we have in front of us. More about market data is the fact that we haven't reached levels of fear that are too dramatic yet. So while the market is falling pretty hard, if you do the math from the high that we got all the way to here, I believe we are dealing with 20+%, 25, 27% drop. So, like a proper extension of a bear market is more around 50%. We saw that in 2008. We saw that with the pandemic crash. So 50%, it's an expectation which makes a lot of sense to me. And I guess not only to me, because when you look at the red line, which represents the implied volatility of options of the S&P, notice how the red line is between the blue lines, being the blue lines, the historical volatility, okay, of the S&P, meaning that this represents the real speed of movement. Guess what? The real speed of movement of the S&P is greater than the red line, which is the implied volatility, meaning that the options prices are still relatively cheap. If there was crazy panic in the marketplace and everybody was buying puts for hedging purposes and to protect themselves, the prices of options would be so much more exaggerated, and therefore that red line would be beyond the blue, which is not the case now. You can see that also when we look at the VIX. When looking at the VIX, we are dealing with an implied volatility of the VIX of 31%. I mean, we reached close to 37% on May 2, okay, which May 2 was more or less, May 2nd was somewhere here, okay? So at that moment in time, more or less here, that's when we reach levels of volatility of 37. Well, we are way lower, but people are not really scared, okay, not really scared. And one of the reasons why is because, there is a lot of buying coming in, pushing for this short-term rally. So it's going to be very interesting to observe because, again, the expectation would be that this short-term rally is just going to bring prices to a higher UFO, and from there the markets will be able to fall. If the market was absolutely completely panicky, then you would probably feel that, okay, so this is the end. Okay, this is the end. The market now is going to have to, normalize. But so far, nothing shows any change of direction of anything because everything seems to be quite well balanced. Okay, even including the fear amongst traders. So this is the volume map. Okay, where what I would like to point at here is the some key information when it comes to open interest. Okay, so we have 370 here. Okay, with a very high open interest. Okay. This is below price at this moment in time. Okay, on the last Friday we closed at 365, but remember we are going to open at 371. So 370, it's below price. So I would expect that when the market opens, probably there is profit taking for the buyers from last Friday that are now having the opportunity to take profit. There will be selling pressure, and therefore I would expect the market to fall right at the open. If the market was to fall right at the open, probably it's going to fall until it gets to the next green UFO. There is a green UFO there. There is another green UFO here. So it's going to be a little bit of a fall, around 370. And when it gets to the 370 mark, probably it's going to go back higher. Okay, that would be my anticipation. But now at 375, and most importantly here at 380, we have extremely high open interest. And again, these could be the levels where we start seeing that short-term rally in a down market stop and start turning around. Okay, so 380 is up here. Okay, it's not that far. So that's why I mentioned that we may get, one, maybe two of the blue dots, and from there go back to green. Okay, so we'll see this developing. Again, we'll meet again soon, I'm sure, and we'll be commenting on what is it that happened, but just keep all of that information in mind, okay? And then from the other reason why in all of this conversation, I sound quite bearish, which again, I'm just reading market data, and I am certainly not giving financial advice. And by the way, everybody here has their own trading plans, and all of this is for you guys to be prepared, for you to understand options, for you to know what's coming, for you to evaluate market data, etc., etc. Again, certainly not financial advice, but the reason why I may sound at times a bit in the bearish side, apart from everything I just said, is also because when you look at the group rotation, okay, which is something, by the way, I forgot to do last week when we met, I'm doing it now. Notice how at this moment in time, okay, when I look at the long term and the short term, if I sort based on strength, so notice how this is red, utilities red, financial red, short-term and mid-term and long-term, basic materials red, consumer services red, telecommunications, that is blue on the long-term, became red in the short-term, healthcare red, consumer goods red, industrials red, technology red, and oil and gas that was blue in the long-term and was blue in the short-term is also red. So in other words, in the mid-term, everything is red. And in the long term, there are a couple of industries, oil and gas and telecommunications, that look stronger. But really, if the mid-term keeps weakening, So the long-term blue will become long-term red. So this sort of rotation, which is now affecting every single sector, is certainly indicative, and we see that happening since some time ago. It's not new, but this is certainly indicative of a proper bear market. Okay, so we got to keep all of this in mind. At the same time, we also want to be flexible. So the fact that I'm giving you, my interpretation of the market data we just got in front of us, that interpretation is to guide you, to help you, to clarify, to, maybe you are new to trading and, you need to kind of like be pointed at what's important for you to watch and assess. So hopefully this is helpful to you. But at the same time, we also, the fact that I'm pointing at a very specific direction here, or just sharing a specific market report, doesn't mean that immediately tomorrow, immediately later, 2 hours into the market trading session, something happens, some news is reported, something is decided by the Fed, whatever, and next thing you know, the market environment, the whole ecosystem changes immediately in an instant. The blue line goes above the gray line. Now we have buyers in the market, and next thing you know, you see all those sectors start moving one at a time from red to blue. This could happen. And if that's the case, we need to be prepared. But so far, there is no evidence that this is happening at all. And therefore, I just wanted to share this with you. Again, not only so you are informed, but also as a note of caution for the newer traders in the community, I would say, which you may be a bit more subject to trading emotions, and maybe hope is one of the dangerous ones. And it's like, okay, it seems it's coming back. Okay, well, maybe it's coming back truly. We'll see that happening. We'll see a change of climate and all of that. But this may simply be a short-term rally in the context of a down market, a bear market, and this is what market data suggests at this moment in time. And therefore, I wanted to suggest caution among everybody out there, so no one gets in trouble, no one gets in any problematic situation. Okay. Anyway, with all of this said, I will say goodbye to everybody. We just concluded our session here. Thank you for joining me, everyone. You've been, I have to say, a bit shy today, so let's not do that next time. It's much better for you to participate more actively. If the lesson today was a bit too complicated and you'd like me to break it down, happy to do so. I plan to add much more contents every single time we meet. So, as you keep watching, things will click. But at the same time, I did want to make sure that all is understood. So, never be shy, even if you have very basic questions. Let me be the one deciding if the answer is coming in the next session or later. But let me help you as well, okay? So see you next time. Take care, everybody, and don't miss my colleague Boyan in less than 15 minutes from now, as he's doing his 3D market commentary as well here in Tiger Brokers. See you, everyone. Take care. Bye-bye.